Hello everybody, my name is Dr. Christophe Fougère. Welcome to Mastering Money. This is part 4, Mindfulness and Finance, lecture number 13, The Brain, Mindlessness, Emotions, the Basic Instincts of Finance and what mindfulness can do for you, part 2. So what are the learning goals? To look at the two key emotions of finance, which are fear and greed, how the brain's bandwidth and emotions can short-circuit good decision-making in finance, and the promises of mindful finance. So, what are the basic instincts of finance? There are really two main ones that are the focus, have been the focus for at least 200 years of market activities. These are fear and greed. And these emotions have been exploited by great investors. For example, Warren Buffett says, we simply attempt to be fearful when others are greedy and to be greedy when others are fearful. So these are great investors that take advantage of big trends in market psychology. In this particular picture, you have an example of one of the earliest market bubbles, which has to do with the Dutch tulip bubble. And you can see in the graph here, you can see the peak of the prices. This is in the late 1600s. And what you have here is at the peak of the market, the value of one of those tulip bulbs was equivalent to the price of a house. So what is the role of emotions and brain bandwidth in financial decisions? Here you have an example of three really heroes of the world of investing in terms of performance. You have Warren Buffett over the period 65 to 2011 that returned and annualized almost 20% a year versus the market at 9.4%. You have Peter Lynch over about a decade that returned about 29% on his Magellan fund versus the 15% for the market. And then John Templeton over 1954-1992 annualized 14.5% versus 11.6% for the S&P. And there was an interesting experiment done by Peter Lynch. And Peter Lynch was running the Magellan fund at the time, and the fund was performing really well. Then asked himself the question, what was the return that an investor in his fund was getting? And the surprising answer was that many of them were getting about, on average, 5% instead of the 29% that he had produced over the period. Why? What was that reason that made the investor in his fund get a lower performance than the fund itself, which seems to be a paradox? Well, this has to do with financial decision-making on the part of these investors in the fund versus the logic of the fund manager. And this has to do with emotions in trading. When you sense danger, the prefrontal cortex bandwidth is so slow that the brain bypasses it to directly go to the fear response system of the amygdala, which then generates stress hormones. And that means fear controls your financial decision making. And we can see some of the bad decision making that people make. And clever people make really severe investment errors. For example, here, if I wait longer, I will miss the trend, so I'm going to buy. But the investor in this case buys almost at the top of the rally, and so buying too late and for too high of a price. Maybe they're going to say, okay, I'm going to use this correction to buy more. Again, they're buying at a price that's too high. And now they're deciding to sell, but guess what? They're selling at the bottom of the market at the lowest possible price. So this is really, they're going to be setting themselves up for losing money that way. So we're looking at emotions driving investors' decisions like fear and possibly greed. John Templeton shares a little bit the same philosophy as Warren Buffett. He states it a little bit differently. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. We're going to talk about the euphoria aspect when we look at Minsky's analysis of what's happening in the economy and particularly financial markets. But to keep on going with what Templeton says, the time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. So if we look again at the Minsky cycle, which we've seen in an earlier lecture, but this time we just put it in the framework of the fear and greed, we can see several things happening, right? In the Minsky cycle, which starts with the initial shock to an economy by a deregulation or a technological innovation, which then fuels a boom, economic boom, which is a justified boom with new economic opportunities. But then there's the financial sector that gets a little bit euphoric, and there's easy credit growth. And that is when greed starts taking over and people start speculating on financial markets and essentially transferring capital from the real economy where opportunities are drying up into financial assets, and they're fueling a speculative bubble. But that's the principal motivator of this is greed. And then the bubble starts. The financial sector may go into what Minsky calls the speculative finance, and then the Ponzi finance, which is to essentially create products with a high level of risk, and people, investors, adopting these products with very little means to reimburse their debts in the case where they're caught where in a loss situation. And then finally we have the panic and crash, and the panic and crash is fueled by the fear, and which makes the market spiral down even further than it should. So we also seen that this is inscribed within what Minsky called the financial instability hypothesis, which states that really this cycle is perpetual in the capitalistic society. It's endemic to the capitalistic system because of the role that the financial sector plays in fueling essentially the greed and the fear factors. Now, if you look at currently what is happening, you have several indexes of fear and greed. I'm going to show you in this case the fear premium. One of the fear indexes that's very famous is the VIX measure, invented by Robert Whaley in 1993. And in my article with Julian Van Erlach, we are the first to actually integrate the effect of fear in the valuation of the market. So not go too much in detail, we incorporate what we call the fear premium, which is purely psychological. And we, for example, do a test, and in May 2009, when the market's trading at 877, that's the S&P 500, we find that without the fear premium, or the fear premium being at 0, the market should have been trading at 1249. So from that point to where it was trading, there was an actual loss of 42% of market value, purely based in our estimation on fear. The fear premium, the way we measure it, has two components: flight to safety and flight to liquidity. So without going too much detail about this, but this is really based on the fight-flight response of the brain. So if we look at the measuring the fear premium, and scaling it in parallel with the VIX, we see that, after June 2007, these two indexes move in lockstep with each other up until August 2009, which is the official end of the recession in the United States. And during that time, the two indexes, the total fear premium and the VIX, are moving in sync, which reflects, in our opinion, the fact that the market is purely moving and the volatility is purely a fear-based volatility. Whereas before that, before 2007, you can see the two indexes are actually not really moving in sync. And in our assessment, it's because the VIX is assessing both upside volatility, which could be a sign of optimism, and downside volatility, which is a sign of pessimism. And whereas our fear premium is focusing solely on the fear aspect and the psychology of fear on the markets. So there's a broad literature in finance about judgment biases and how that affects investors. For example, you have something called the confirmation bias, where people who have strong investment thesis or beliefs about the way the market's going to be heading up or down, and they become strongly invested in that story, in that narrative. They're going to look for confirming evidence of their thesis, not really assessing neutrally and objectively what may happen. And in a lot of cases, they put their investment at risk doing that. There's a lot more behavioral biases that are listed here. We talked about anchoring a little bit earlier. But the key notion here is that when we look at some of these biases, they really are coming from the release of particular hormones in the brain. And when we look at, for example, winning versus losing, losers experience low levels of testosterone and high level of cortisol. Cortisol is produced in response to stressful or uncertain events, and it is a fear response hormone, which tends to paralyze decision making or paralyze objective decision making. And that means it can be detrimental to future decision by somebody who falls victim to this kind of spike. And that means that, for example, they may decide not to come in a market even though it might be a great buying opportunity. On the other hand, winners, it seems like it's a great thing to be a winner to a certain point, because they will experience spikes in testosterone. And testosterone makes people act in a more aggressive manner and maybe take on more risk, which may give you a high, but at the same time may also bias your judgment. And when people experience too much testosterone, that creates a feeling of invincibility that may lead to impulsive decision and extreme risk taking. So that also may lead to adverse outcomes. So I'm going to invite you to take on maybe this notion that there is an alternate way to regulate these emotions and to put them in the context of a financial decision-making process. And I'm going to call that mindful finance. So it's going to start from the notion of mindfulness, which exists in the world right now, and in the business world, which has been integrated in many companies. And what is mindfulness? Mindfulness is being present where you are right now with full awareness and consciousness. John Kabat-Zinn, who is a physician and who is one of the originators of the concept as a secular concept adopted in medicine first and in the Western world in businesses. Of course, there's a more ancient tradition behind this concept that dates back thousands of years, but he's the first one to have popularized the notion. He says, mindfulness is about paying attention in a particular way on purpose in the present moment and non-judgmentally. So what is mindful finance? Well, it is the field of knowledge that helps you being present and fully conscious to what you are doing and feeling while pursuing your financial professional activity, helping you conquer judgment biases that finance professionals are particularly prone to fall victim to, and which are caused by the two main key emotions of finance, fear and greed. So it's interesting, but there's research that shows that the brain has the ability to change itself, and neuron connections can actually be changed by thinking. That is, by creating new, for example, by learning new things, the brain responds by creating new neuronal connections. But MRI scans show that after an 8-week course in mindfulness practice, the brain fight or flight center, the amygdala, appears to shrink. This primal region of the brain associated with fear and emotions is involved in the initiation of the body's response to stress. And as the amygdala shrinks, it looks like the prefrontal cortex takes more importance in the brain, and so therefore is activated in a more powerful way. There's a reduction in cortisol and some of the negative kind of, or I will say not negative necessarily in any context, but the ones that are not necessarily productive in terms of achieving the best possible decision-making process. So how doing finance mindfully can serve you? Well, it helps raise your awareness of what you're doing, feeling, and why, which increases your ability to regulate your emotions without judgment, which allows you to engage in cognitive processes that reinforce habits and beliefs in alignment with your goals and values, which then may lead to better financial decision-making and ultimately a greater personal fulfillment. So by experience, people have documented that best investors have learned to listen to the subtle signals and biofeedback from winning and losing. They know when to be patient and when to be aggressive. They know when to have a small position and when to size up. They are conscious not only of their emotions, but of the emotions of the majority of other market participants. And listening to your emotions and recalling similar situations, the outcome can make your trading action crisp and increase performance. Recognizing why you're too hot or too cold is critical. So this is what we call self-awareness or mindfulness about your emotional state, which then enables you to step away from these emotions and consider making decisions in a more, let's say, a rational way. So thank you very much for your attention.